Hello, and thank you for watching this video. I am working on some analysis for some meetings coming up for Tennessee clients. And one thing we're talking about is entity selection and the difference between either being an S corporation or operating as a sole proprietor, which would be on Schedule C, a single member LLC, which would be reported on Schedule C, or if there's more than one member, a partnership, which the income would be reported on a K-1. This video should not be used for specific tax advice, as everyone's situation is different, but I wanted to put something together to share so that you can, if you're watching this and you're thinking about entity selection, you can kind of take a look at what CPAs think about when we're advising a client. Now, the situation I'm videotaping right now and that you're looking at is your most basic situation. The assumptions are it's a married filing joint couple. There's no other income. There's no spousal income. There are no dependents. And there are no wages paid out of an entity to non-owners. There's also no retirement plan contributions, no fixed assets, and the taxpayer's taking a standard deduction. So again, not many people live in this type of bubble, but this is our base just to take a look, and I want you to see the interplay between Tennessee specific franchise tax versus federal income tax and really triggering that 199A deduction. Typically, if we have clients that exceed the qualified business income deduction or 199A deduction income thresholds, we're going to plan and strategize to make sure that we pick those up. The other thing we're going to say is that let's assume that the reasonable compensation, if S Corp was elected in this type of entity, is $75,000 for the owner. Now, we run reasonable compensation studies for our clients to determine what is appropriate and IRS compliant. But again, this is a very vanilla sample. And what we look at when we're looking at the S Corp versus Schedule C/K1, which I just described, is, okay, what is your total tax exposure based on different breakpoints? So when we look at the net business income before wages, we look at, okay, what about $500,000, $300,000, $150,000, and $75,000? And we're looking at three different types of taxes. We could actually eliminate the 1120. We're going to look at federal income tax, so that's going to be on your 1040. We're going to look at payroll tax, which is going to be only if you're an S Corp, and Tennessee franchise and excise tax. Tennessee franchise and excise tax is a 6.5% tax on income. We already stated that there are no significant fixed assets, so we're not worried about that exposure. Although if it's an entity that has significant fixed assets, then the franchise tax could play a more significant role. So in the example one, $500,000 worth of profit on just a straight Schedule C or K1, your federal income tax is going to be $143,400. You'll pay the minimum franchise tax. We're also assuming you're not qualifying for the FONS exemption. Your total tax exposure is $143,500. In the S Corp scenario, same fact pattern. If you pay yourself $75,000 worth of wages, your federal tax does go down, but you are subject to payroll taxes and Tennessee franchise tax, and your total tax is about $150,000. So this tells me Schedule C is better. And again, we are saying no retirement contributions because if you are going to contribute to a retirement plan, most likely, depending on how much money you want to contribute, a SEP contribution with the Schedule C or K1 might make more sense than an employer-sponsored plan with an S Corp. Again, let's look at, for $300,000 worth of income, we're looking at total tax exposure on the S Corp of $70,200. Total tax exposure Schedule C K1 $63,800. So you can see as the income goes up, the S Corp the case for the S Corp goes down. You are triggering here the qualified business income deduction based on wages. At $150,000 of profit, $75,000 paid to the owner, you're going to see a little pocket where the S Corp makes sense. So what we're finding is between about $125,000 and $175,000 worth of income before owner pay, the S Corp, there is a case for the S Corp in the state of Tennessee. One thing to consider, though, is if you make an S election, you're pretty much stuck with that election for at least 5 years. And there are some other tax implications that I'm not going to go into on this video. So think about the S Corp as a permanent decision, not something that you're just going to make based on 1 year income. And then at $75,000 worth of income, you're going to have to take some type of reasonable compensation, so the S Corp doesn't have a profit. So there's really the tax exposure on the franchise tax is gone. You are hitting payroll taxes and your federal income tax. At that point, the Schedule C still makes sense. So really, unless you're in that small pocket in the state of Tennessee, Schedule C K1, I would say at 90% of the time is going to make more sense than the S Corp election. Hope you found this video informative, and I appreciate you watching it. Feel free to share it with anyone that is interested. Have a great day.